Welcome back to the Investing Show. Joining us now, we've got Tom Beckett of Sigma Investment Management. Tom, welcome to the show.
Thank you, Simon. Thank you for having me.
So we've seen some fairly spectacular gains in markets and a real sort of turnaround in sentiment since the depression of the start of the year and also the worries over Brexit. What do you think is driving that, and can it continue?
Well, long may the gains continue, although they might not. I think there's probably two answers to those questions, and I think they are actually separate questions at this point in time. I think with regards to the recovery from what you rightly confirmed as being a depression at the start of the year for financial markets, I think it's confirmation that the world economy has probably gone from the emergency room to the recovery ward. It's not a very strong recovery, but things have improved. I think the second point is that central bankers once again have completely confirmed their dovish tendencies. They want to do everything they can do to keep asset markets buoyant and have been very successful with that in the last few months. And I think finally there were just a lot of opportunities, which I know I discussed with you guys earlier on this year, that offered patient, contrarian investors the opportunity to make some serious money, and that's what's happened in the last 6 months. I'm delighted to say. The second part of your question, post-Brexit, I think it's a bit of the former answer. I think certainly the central bankers are once again the chief culprits, or the ferries on our shoulders who've guaranteed the market's recovery in the last few weeks. But I think you're in a situation whereby, because of the actions of the central bankers and because your viewers, our clients, all of us, are in a situation whereby making a return on one's money is becoming harder and harder and harder. People are having to put money to work in financial markets, and that's really guaranteed that certainly the summer so far has been much more enjoyable than some of the previous vintages of the last few years.
Do you agree that there's still a bit of a wall of cash waiting on the sidelines, waiting to be invested, or do you think that's something of a myth?
I think it is something of a myth, personally, but I think the inescapable fact from listening to our investment managers at Sigma, listening to our clients, speaking to anyone, is that the pressures that people were feeling with regards to making a return in a world of zero and negative interest rates is just intensifying. I know certainly with regards to investments we've got, we're tempted to take profits, take some money off the table, but where do you replace the income? Certain assets are starting to look expensive, but what are you going to do? Put it into cash earning you nothing? I can justify with that with some of our assets for a defensive purpose, but these pressures are only intensifying. So the wall of money will always move around various different asset classes. I'm still yet to be convinced there is a huge amount of money waiting to come into asset markets, but hey, it's been the case for the last few months, and I suppose can continue.
So obviously a lot of this is, as you say, being driven by monetary policy. Basically, interest rates are low, and earnings haven't really done that well. They're not necessarily justifying the uptick in optimism. We've seen a rate cut here to deal with Brexit. We've then seen a load more QE, some corporate bond buying, and something that probably actually will work more than any of the other things, I think, which is the thing that looks like funding for lending too. Mm-hmm. Do you think all of that medicine was the right move?
I think it's all entirely pointless, apart from driving asset markets up higher. I've seen absolutely no evidence that lower interest rates are a help. In fact, I think actually they're a negative for the economy looking forwards. Providing the banks with more liquidity, well, the banks have got too much liquidity. The reason bank shares haven't gone up for a very long time is that banks are struggling to make any profits. And I think the fact they've got so much liquidity, they're being told to lend by the government on one side and being told by the regulators not to lend on the other side, is creating a completely ludicrous situation. So I don't think that will help. And with regards to the corporate bond and gilt purchases, well, it's made, in my mind, already expensive assets even more expensive, and we've got fixed interest investments in our portfolios, standard gilts and standard corporate bonds. They're up now 16% and 9% respectively this year. What it's taken from our clients and our investors, money that should have come in the next few years, and brought it forward. So I don't think it's a benefit. I personally think that interest rates in the UK should have gone up 2 or 3 years ago, and we'd be in a much better place now. But sadly, despite the fact Mark Carney's finally done something, central bankers don't want to listen to what I've got to say.
Well, I wrote about this as well last week. I think it's an abject failure that we've got to 7.5 years down the line and we hadn't managed to put rates up before we decided something so bad had arrived that we had to cut them again. But I think we're definitely getting to the point now where people are thinking that, regardless of the fact we've just had the Bank of England's big bazooka, we're thinking monetary policy is running out of steam. Even Mark Carney himself has said it. So you touched on something in a recent blog about fiscal policy, about basically spending some money, investing in infrastructure. Can you tell us why you think that's a good idea?
Yeah, well, I'm glad that someone actually reads my blog, so thank you for that, Simon. With regards to the situation on fiscal spending and infrastructure, I think we are now in the situation where central bankers have tried everything and failed. is my personal view on the last 7 years. So I think we're now in a situation whereby even politicians and central bankers are working out they might need to do something different. And I think the tone and the language certainly, and I hope they're going to back up their words with actions going forwards, from places like South Korea and Canada as being early movers, Japan recently, are all certainly talking about more fiscal spending and trying to boost their economy in that sense. The fact that Mr Osborne's been kicked from the front bench to somewhere towards the back of the House of Parliament, and the new tones from Philip Hammond suggest that in the UK we might see a bit more fiscal stimulus than we've seen certainly for the last few years. And in the US it's very hard to find anyone talking about the deficit anymore. I don't think Mrs Clinton or Mr Trump, amongst all the things they've said, have talked about the deficit very much. So my personal view is that they are going to start to try and do something different. That will probably lead to a bit more infrastructure spending at the margin and a perhaps loosening of the government's purse strings. And frankly, given you can borrow money in lots of parts of the world for free, I mean, if you're the German government or the Japanese government, who I've got to say are populated by complete idiots, so they probably won't do this, you can go out and borrow as much money as you want to and be paid for the privilege of doing so. Using that money to go and build infrastructure spending and efficiencies in your societies has got to be good. Whether they'll do that or not, I don't know, but frankly, that's the only medicine that I can see curing a patient in the form of the global economy, which has been ill now for 8 or 9 years. So I'm hopeful we'll see some evidence of that, and we've recently made some assets, bought some assets in infrastructure to try and take advantage of that. So I'm hopeful, but I won't promise it.
Do you think there's any sort of irony in the fact that obviously what central banks are trying to be doing in some way is that by keeping interest rates low or even negative, they're trying to encourage companies to invest in stuff, whatever that stuff may be, but it's had the opposite effect in as much as because of the broader volatility, they're sitting on their hands.
Yeah, I mean, it's massively ironic, and I'm afraid it's one of those log jams that has to clear for the global economy to move forwards. But you've got that in the corporate sector. Companies can go out and borrow for free and don't want to invest. That will probably lead to a bit more M&A, in truth, and I think that SoftBank's approach for and takeover of Arm is a classic example of that. I mean, I think that's one of the things they'll do, and also they'll keep on buying back their stocks, they'll keep on increasing their dividends, and they'll be issuing very cheap debt to do that. But that's not going to be enough to get the global economy moving forwards, as you rightly say. But it's not the only logjam out there. The other logjam out there is the fact that you've got the governments trying to press the banks to lend money, and the banks do want to lend money, but they want to lend it to people who don't want to borrow. The people who want to borrow can't borrow money still, and frankly, going back to your question on Mark Carney's action, that's not going to clear that logjam. And I think until, you quite rightly said, the corporate sector, that irony stops, and in the banking sector, where consumers can once again borrow properly, I'm afraid there's going to be much more of the same to continue from what we've seen in the last 7 years.
So, I mean, obviously the issue with the increased infrastructure spending is you've got this problem of austerity, basically, that we've decided that we're spending too much money, we're not balancing the books. But presumably the issue, from your point of view, has been that, George Osborne failed to differentiate between overspending on the things where you're just basically borrowing to fund your day-to-day spending and what actually counts as investment in, the fabric of the country and the economy. But if you look at his budget speeches, there's been a mention of infrastructure going back in every single one of them, all the way back to 2010.
Yeah.
But presumably what you're talking about isn't the kind of high-speed 2 project that basically is announced to help save us from the financial crisis, and there won't be a spade in the ground before 2020 if we're lucky. It's the kind of stuff that's the much easier wins.
No, I think that's absolutely right. And but this talk of austerity, let's be completely honest about this. Our debt pile has kept on growing every single year. I just think the way the government has used the money has been inefficient. And I think that, you rightly point out, there are much better ways for us to be efficient. And that is exactly applicable to other parts of the world as well as the UK. I mean, you go to Germany, as an example, the infrastructure there is very, very poor. And German companies have said we're being held back by the fact that our infrastructure is poor. Motorways, railways, all of it is poor and can be improved. And I'm very lucky and get to go around the world, and you go to a place like China and Japan where infrastructure is excellent, and then you go to a place like the US where it is frankly appalling. The US is being held back massively by infrastructure spend. So you're right, there's talk of infrastructure and then there's action. The talk so far has been quite hot, the action's been quite poor. But governments around the world have really got to recognise that if they want to start back a positive feedback loop in the economy, which is what we really need, that probably has to start from government spending. And going back to your point earlier about the corporate side of things, I think if corporates were to start, or companies were to start to see government spending efficiently on infrastructure, they would then see that as a tick in the box and a green light for them to be doing likewise. Until we see that happen, as I said, I think we are stuck in this slow Nike tick slight recovery that we've seen since the financial crisis, which frankly has been here for too long.
So the million-dollar question, obviously, that all of our viewers will be asking is, how do you invest for this? If you buy into this case, how do you invest for this? What have you been buying? What have you been doing?
Well, Simon, as you've known me for a long time, you know I'm very cowardly, so I can promise you we're taking a very diversified approach at this point in time. But that being said, I think there's two things to take into account. The reasons we're diversified are that many asset markets, frankly, look expensive. Government bonds, corporate bonds, many equity markets. So it makes sense not to put all of your eggs in one basket, and I'm sure that many of your readers are following a similar strategy. And I think the second point to take into account, when I came in earlier on this year, I might have sounded even more ridiculous than usual when I talked about some contrarian opportunities, things like the mining sector, things like US high yield credit. A lot of those great ideas in hindsight have actually paid off this year. So actually, I think it's prudent, given the moves we've seen in markets, to take some money off the table. That being said, you know, we can still find some great investments. Japanese equities to me still look to be outstandingly cheap. I still think that investments in the energy sector on a long-term basis all around the world look quite attractive. I think investing for dividends will carry on to be a great strategy. And one of the things that we highlighted earlier on this year was emerging market assets. And I think in an era that interest rates around the world aren't going to go up very quickly, and actually global growth might start to pick up, particularly if some of the fiscal spending starts to come through, actually that should be a pretty decent environment for emerging market assets. You're not going to see the 25% sort of returns that your readers and our clients have seen so far this year from EM equities, but I think you'll see decent returns going forward. So I might always sound cautious, but I can promise you that I can still find lots of places to invest our clients' assets. Just as you rightly pointed out in your introduction, prices aren't what they were 6 months ago.
And obviously there's going to be UK companies, if we do go and splash out on actually doing some stuff and building some things, there's going to be UK companies that will benefit, won't there, Richard? You're looking at it from an individual company stock market perspective.
Yeah, I'd like to take the old-fashioned approach on that. If there's going to be a big infrastructure project or projects across the UK, there's going to be the creation of jobs. There's therefore going to be more consumer spending, etc., and that will filter through in all sorts of places, let alone the companies who get awarded the contracts, obviously. But yes, I mean, it's long overdue, as Tom rightly says, and you know, it's arguable that this is probably the time to strike, having a new leader at the helm.
So looking ahead to the rest of the year, basically, and
We'll
then on into 2017, as is your job.
Yeah.
Glass half full or glass half empty?
I think the glass half full, mostly because the other half has been drunk. Quite obviously by investors in the last 6 months, and rightly so, they should be rejoicing after seeing really good returns for the first time in a few years. But you know, I think with the fiscal things we've talked about previously, I think with the fact that the consumer sector and the corporate sector doesn't look to be in bad health, I think with the fact that confidence should start to improve, led by government spending, and I think from the fact that, you know, we are in a truly unique situation where your viewers, our clients, all of us are in a situation whereby if you want to keep money in the bank or want to go out and buy very safe assets, you're not going to get a return. I think the fact that we've got expensive valuations could stick with us for quite a long time and actually could easily intensify yet further. So I think from the perspective of being glass half full or glass half empty, I'd like to say that I am cautiously optimistic, and that's a pretty natural stance to find at this point in time.
Tom, that's all we've got time for. Thank you very much. Richard, thank you very much.
Thank you.
Join us next time on The Investing Show. Goodbye.